Okay, next up we've got Gareth Solly, Managing Director of Black Cat Syndicate. Gareth's career incorporates over 25 years mining industry experience covering numerous commodities, deposit styles and mining environments. He also has experience leading geology and mining teams, having worked as Chief Operations Geologist and Registered Mine Manager in both open cut and underground operations at Saracen Minerals, Silver Lake Resources and Norilsk. Please join me in welcoming Gareth to the stage.
Thank you very much, Jeremy, and good afternoon, ladies and gentlemen. It's a pleasure to be here and presenting the Black Cat story for the first time at a Diggers and Dealers mining conference. So, for those that don't know Black Cat, and I assume everyone's heard of us by now because we've been around 5 years, we are a gold-focused business. We have 2.4 million ounces of high-grade gold spread across 3 operations, all within Western Australia. So, Cal East, Paulsens and Coyote up in the Tanami. We have 2 installed plants at Paulsens and Coyote, and we've got a third that's ready to construct here in Cal East. We have released robust studies on all of these recently, mining studies, and there's significant upside potential in all of those. And our intention is to sequentially develop these, so in a low-risk manner that'll allow us to build our company to 150 to 180,000 ounces per annum. Now, there's nothing new in what we're doing. We've got existing operations. We're looking at refurbishing mills and getting them back up and running. It's the same process and pathway that many other large Aussie producers have followed. And there's 3 examples on the screen here. High-grade underground resources, established infrastructure, relatively modest production targets, small initial mine lives and small initial market caps. 2 of these went on to produce the left-hand column, 630,000 ounces from that operation over a 7-year period. And they went on to acquire other assets, and they're a $13 billion company. We've got, in the middle, an operation that's produced over 1 million ounces for that company now, and a $1 billion market cap. And on the far right, that's us. Paulsens asset, the starter asset for us. Who knows where we'll get to in sort of 15 years' time. And you've probably guessed that Northern Star was on the left and perhaps Silver Lake in the middle. Importantly, my board is also the board that founded Silver Lake Resources, so same team, same strategy, and our starter asset is actually the same asset that that Northern Star started on. So, the same options, the same potential. Additionally, we've got 2 other projects, Coyote and Cal East. Now here they are all lined up. We've ordered them here from 1 to 3, left to right. That's low capital to higher capital. Our intention is to start Paulsens, requires about 42 million in capital. That's CapEx and pre-production mining. We intend to get this to a run rate eventually of 60 to 70,000 ounces per annum. Coyote is the second project here. Over 5 years, it'll mine 200,000 ounces and generates quite good cash flow with low all-in sustaining costs. And then Cal East, just outside of Kalgoorlie here, is the third. Again, good all-in sustaining cost. So strategically, we want to build each of these mills. We want to refurbish and upgrade and build these mills and get each of them up and running to be a producer somewhere in the order of 150 to 180,000 ounces per annum. Quickly on the corporate structure, 267 million shares on market, about 100 million market cap. We've got some decent funds, quality funds on our register already, and our board hold about 10%, having invested 8 million of their own cash. That board includes, like I said before, founding directors from Silver Lake. That's Paul Chapman and Les Davis. We've also got Philip Crutchfield on our board, and he's a King's Counsel on the east coast of Australia, but also on the board of several other junior explorers. Tony Polglaze has built mills all around the world, and myself, I'm a mining geologist, background with Silver Lake Resources and Saracen. So I'll talk to Paulsens first. That is our focus. We want to get this operation up and running. It's the same operation that allowed Northern Star to start producing and be in the position that they are today. So here we've got a fantastic exploration package, and obviously we've got some high-grade resources as well. Got a well-maintained plant, 450,000 tonne per annum capacity, dewatered, ventilated underground. There's an image there of the AUD rig. They're in the underground at the moment, drilling holes, increasing resources and increasing mine life. And importantly, when we get this built, it's going to be the only processing plant operational within a 400-kilometre radius. I'm not going to run through all these numbers. I will say that there's resources that haven't come into the study yet, and we're not filling the mill to capacity, so there's certainly room to have more ounces coming out of this. Also, lots of grade potential, and that should see all-in sustaining costs drop into the future. This slide's an interesting one. It shows history of Paulsens, but also the potential future of Paulsens. So it's been mined by a couple of companies. Intrepid commenced here in 2004-05, and they mined the first 400,000 ounces. They thought this ore body was ending. They lost focus and moved on. That was the opportunity for Northern Star to come in, make discoveries, and mine another 630,000 ounces. Northern Star grew very big, and certainly they thought that this ore body may be ending, I would have thought as well. But this was the opportunity for Black Cat. We've come in and picked this up. Now, we've developed a mine plan that's all in the top part of this mine, adjacent to existing workings. There's 130,000 ounces that gets us started for the first 3 years. And we have, post our study, discovered the extension to the main zone at depth. So we've added another 100 vertical metres there. It does need to be infill drilled. It's not in resource yet, and it's not in the mine plan clearly. This is what it looks like in a bit more detail. So 100 vertical metres is an area that's got some good grades and good widths, and certainly we're doing some more drilling in this area. But this is a fantastic opportunity for Black Cat. It's a strong value driver. This will extend mine life. This should increase production rates, and this should increase cash flow. So our initial 3-year plan looks like it should grow fairly strongly from this and other parts of the underground. But this mine has never really had a very long mine life anyway. So traditionally, there's been 112,000 ounces in the production target, so in the sort of reserves. For us, we've already got more than that. We've already got more resource than the average. We've increased that with 7 months of drilling to by about 3.7 times. And if you look at the history of production here, although it had a 112,000 ounce target, it produced consistently for between 70 and 80,000 ounces per annum, and produced over 1 million ounces. In terms of the restart plan, very simple. So it's basically a 6-month refurbishment process. It's like a large maintenance program in the mill because it's all already established. Upgrades to the electrical systems and the power generation. We start mining about 2 months prior to commissioning. That's just to build some initial ROM stocks. It's conventional production, long hole, stoping, jumbo development, small amount of air leg as well. So this is an approved site. It just needs the mill to be refurbished and mining to recommence. In terms of deliverability, there's a lot of knowns here. Obviously, there's a long operating history. We've had GR Engineering do the refurbishment plan for us. We've already got the general manager for site on board, and we've got the processing manager on board, the underground mining manager on board, and underground geologists in the underground. So we really are well set up. We're also fielding lots of expressions of interest from people that have either worked at Paulsens before and want to come back, or want to work with our management team. So we're quietly confident that we should be able to fill all the labour positions we have here. There's lots of exploration targets, and I won't go into all of them, but there were 2 transformational targets that we had here when we first picked up Paulsens. One was to extend the Paulsens main lode at depth, so tick that box. Obviously more work to be done, but we have discovered that. The other was to find the repeat position, which is following the same shear that creates a void in the Paulsens gabbro down to where it intersects the lower gabbro. And we've started doing that work. We've certainly identified the shear at depth. We have not intersected the lower gabbro yet. So this is a fantastic target which may replicate sort of the Paulsens lode. Belvedere is about 5 kilometres from the mill. It enters our mine plan in the 3rd year. There's certainly open pit potential and growth in the open pit potential here. And then we have underground potential on the back of that. Lots more work to be done here. We want to be drilling here later this year. There's a 2.5 kilometre long mineralised fault, and there's more work to discover more ore in this area. And we have a lot of other targets, obviously, at Paulsens, so we're spoilt for choice, but they do range from early stage all the way through to near reserves, and we'll sequentially work through these so that we've got a continual flow of ore to the mill for years to come. Quickly over to Coyote. Here again, we have a fantastic tenement holding on the Western Australian side of the Tanami Belt. We own the only real infrastructure in the area. So fantastic ground from an exploration point of view, but also a very high-grade resource that we have here. And the underground is 14.6 grams at Coyote itself. So our mine plan here, mine's 200,000 ounces over about 5 years, generates healthy cash flows of 176 million. And I think the other point on this slide is that, once we get this facility built, it's the only processing facility that will be operational within a 200-kilometre radius. Lots of exploration potential in this area. The other thing here is, of course, it's a scoping level study, so there's more to be done. Certainly there's debottlenecking and there's optimisations that will go into this, which we think will improve the outcome. There's 372,000 ounces that aren't at almost 5 grams that aren't included in this study, so there should be more that comes in the long term. And like Paulsens, this is a refurbishment of an existing facility. Our plan is to upgrade it with a mill that we already own that's sitting out here in Cal East, and take that up there and upgrade this mill. Here's a long section through Coyote, very high grade deposit, and we've got an open pit that takes out the oxide over the axial core zone, and then we'll be into the underground. The underground will only be mining fresh material, has an average grade coming out of about 5.4 grams per tonne. And there's lots, obviously, that's excluded from the current study. Quickly over to Cal East. We've got a very short presentation here, but Cal East itself is obviously where we initiated the company 5 years ago. We had an 80 square kilometre tenement holding and no resource. We've now got 1.3 million ounces there. We did an update, we released a feasibility study last year. We updated that this year, produces 168 million cash flow over a 5-year period after we build an 800,000 tonne per annum mill to the east of Kalgoorlie. And so that mill is also out on site. We have 2 mills here in Kalgoorlie. One will be used here and the other up in Coyote. Lots of reserves in this study, and there's about 700,000 ounces at 2 grams that has yet to be included. So more work to be done. This project will continue to grow in time. So the 3 projects again, Paulsens, Coyote, Cal East, ordered from lowest capital to highest capital, sequentially start them, get the first up and running, use the cash flow from that to assist to build the second project, etc. So we've got three projects which will all belong in a junior, all in the one junior company here ourselves. And they're all strategically very important in the areas that they live. Activity is clearly going to be focused on Paulsens. That's where we want to recommence first. So we're going through funding options at the moment, looking at debt term sheets, and going forward, there'll be about a month to mobilise a crew to site, and then about a 6-month process to refurbish the mill. So we could be pouring gold as early as the first half of next year. Obviously that's taking up our focus. Coyote and Cal East have less activity until we get Paulsens up and running, and then we'll change tack and go to the second. In terms of re-rate potential, once you do become a producer, you should expect some sort of re-rating. The average enterprise value for smaller Aussie gold producers is about $4,740 per production ounce. So notionally, if you're a 50,000 ounce producer or a 150,000 ounce producer, you could expect a re-rate to 240 or 720 million enterprise value. So to summarise, we're following a proven strategy. Plenty of other companies have done this before successfully, to be a multi-operation producer and potentially have first gold in the first half next year. We've got a low-risk strategy to sequentially develop each of our projects to minimise dilution to shareholders. We've got high-grade, high-margin projects that require low capital, and we've got significant scope for re-rating once we do become a producer, obviously with strategically located mills. So thanks very much. Please come and see myself and the technical team that are in the booth should you have further questions. Cheers.
Thanks very much, Gareth.